Hello value investors, thank you for watching. In today's video we're going to talk about Hewlett Packard Enterprises and whether there's enough upside potential at its current valuation. So if you're new to the channel, please subscribe now so you can get my next video installment. Also, I have a newsletter on Seeking Alpha Marketplace where I talk about the stocks I own and why, offering a balanced argument for each investment. So let's get started. Essentially, what I'm looking at here is that the company was doing quite well in 2018-19. So you can see here on its operating margins, it's a non-GAAP operating margin, but you can essentially see that when the economy was particularly strong in 2019, it was kind of in the ballpark of about 9% operating margins, which is fairly okay. You know, it's not the highest, but it's more than reasonable. However, when the company hit hard times here, starting 2020, did that operating margin really compressed. So it has a substantial operating leverage, and that can work in two directions, and it's not as alarming as it looks. There's this kind of purple line coming down here. It's just something to bear in mind. So if the company is able to reignite its revenue growth rates, this can really turn around, and that can be very, very attractive. And on that front, I am definitely watching this company. It is not clear-cut one way or another because its valuation is attractive, and we'll come to that in a second. But what I want to note is when the company talks about having a very strong balance sheet, I am not so sure that it has such a strong balance sheet. So if you just forget about its financing arm for now and you just look at its underlying operations, you have approximately 4.6 billion of cash as of Q2 2020, but it has a substantial amount of debt. So that's not the financing side, that's just simply the debt to the company. So it has a net debt position of 400 million. Now, it's not the end of the world, but it's not as strong. So when the company says, we have a very strong balance sheet with 10 billion of liquidity, you have to remember that nearly half of that liquidity is coming from basically credit facilities. So these are undrawn, and it does give the company plenty of wiggle room, but it's not really that the company is generating that cash and is just laying on its balance sheet. So just to bear that in mind. So again, this is that thing that we talked about, the financing side of the company, which is not that attractive to me, but when the company talks about strong liquidity, I want you to think about that. Moving on, as I note in the article, it does have a very high dividend. So the dividend is approximately a dividend yield of approximately 5%, and I think that is quite a sustainable level. It comes up to approximately 620 million for the year, so I think that it might come out with some free cash flow approximately in the ballpark of, let's say, 900 to a billion, maybe a tiny bit more than that in 2020. So that is pretty much covering the dividends. Obviously, that kind of cuts into the share repurchases, and that's why the share repurchases got cut back in 2020. They may resume later on, but for now, what we see is what we get is that 5% dividend, and the repurchases have kind of just for now kind of been suspended. So another thing that I think is worthwhile commenting is that they talk about this as a service business unit, but in the best case, if you take that guidance that they have, that it's going to grow between 30 to 40% over the next 3 years into 2022, if you look at the top end at a 40% rate, you're kind of getting less than 1.5 billion. You're probably getting close to 1.4 billion for that business unit, for the as a service that they talk about being the high profits and very recurring sticky customer. It's not really everything, because if you think about it, if you're looking at the company making 29 billion, by 2022, if it makes at the top end 40% compounded annual growth rate on that business, it's 1.4 billion, which is less than 5% of the businesses. So it's not really what's going to make or break the thesis here. Moving on, I think that it's worthwhile thinking about this valuation. Now, this is why I'm looking at the company in the first place, because before they pulled their guidance on the gap side for 2020, at the midpoint, they were pointing towards $1.08 for its EPS number. So given that the company trades for less than $10, that seems quite, just quite attractive. But if the company cannot really turn around its revenues, it's kind of like, dare I say, close to fairly priced right now. But it's just well worth watching. And once Q3 comes around, Q3 2020, and we see that things have actually stabilized, and that it is a possibility that what happened in Q2 2020 was really related to COVID, it could be quite an attractive opportunity. So I think this is one worth watching. And as always, hope you found this video useful, and please subscribe. I'll see you next time.